Good afternoon, everybody. There have been two criticisms. One is that I don't wear my headdress enough. And two, we've had too many bears. We've had Nouriel Roubini, David Murren, James Gubb, Rob Hersov, and all those other bears. We need a bull, and our bull has arrived. Yogi Dewan, welcome. Be in the market now.
Thank you for having me on your show.
Now, the hardest thing of all before we start is to get Dorian's last name right. And he's really given me a hard time. So, Yogi, repeat after me. Dorian Prosdocimi.
Prosdocimi.
Yay.
So, Yogi, how can you be a bear in this market? Just check.
It's very easy. It's very easy to be a bear in this market with what's been going on with COVID. Look, you've got 5.9 million cases worldwide. You've got 353,000 deaths. Markets are down 8 to 9% year to date. Everybody's been talking about a V-shaped recovery or a W-shaped recovery. You've got lots of anxiety around economic data and earnings. The unemployment rate is escalating in the US and in Europe. And when you actually look at what's actually going on with earnings, the numbers have been pretty shocking. You know, revenues up 0.8%, earnings down minus 14%, and that was Q1 that's just taken place. If you go to Q2 numbers, the revenue decline is going to be about minus 12%, and the earnings decline is probably going to be in excess of minus 40%. And heaven forbid you're small cap, the numbers are even more ugly. So there is a case for being quite bearish in this market. You will have heard it multiple times over. We're not as bearish as the market. Cautious optimism, and happy to go through the reasons and the thinking as to why we think things aren't as bad as everybody thinks.
Before I hand over to the really clever guy, Dorian, one more question. It's easy to be bearish. It's tough to be bullish. But what's going on in the market right now? Give us the last few weeks and yesterday and today. What's actually happening?
Yeah, look, markets have come back. So if you look at what's actually going on, there's three big questions that are being asked at the moment. Can the equity market rally continue? Number one. Is the vaccine treatment optimism justified? Number two. And then number three, you know, there's this whole debate around the US Democrat election win later in November. Big question mark about what's going to happen to Trump or whether Biden's actually going to get in. So they're the things that everybody's focused on at the moment. If you look at markets, they've really pulled back from the market lows that we had at the end of March. We've arguably had the shortest bear market in history. If you like, an easing of the pandemic rally, an easing of a pandemic rally. And the way to look at this from our perspective is we've been talking about a V-shaped market recovery. Well, guess what? It's already happened. It's happened and it's now behind us, and we're starting to think more about a W-shaped recovery. But markets short term right now, they're just so focused on COVID-19 infection rates. They're so focused on easing lockdown restrictions. And obviously the lockdown restrictions that have been announced were very appropriate and required and probably saved lives. But now we've got everything changing. I think everyone's kind of relieved, but also there's a mix of trepidation as well about what's actually going on, reinfection rates and whether it's too soon. There's lots of positive news flow around virus testing rather than drug therapy or vaccine development. Drug therapy is probably 6 to 12 months out in our mind, and vaccine development 12 to 18 months out. But the virus testing is clearly very, very important. And then you've just had masses of monetary easing and fiscal support, most of it coming from the US. Obviously, it's providing a fundamental flaw to the economic slowdown and equity markets in general. If you look at it, we've had $9 trillion actually announced so far. And in fact, today we're having further announcements from Europe. We've just had another 1.1 trillion announced from Japan, and there's more from the US to come in quite a meaningful way. This is all helping markets. It's providing support. And, you know, I mentioned the Q1 and the Q2 numbers. Everyone's just ignored them. Everybody's really ignored them. Everyone's now starting to look beyond those numbers, and they're starting to think about what's going to happen in H2. And they're basically ignoring all of the unemployment data and all the poor economic data because there is a belief that things will snap back. And you've got that level of optimism in the marketplace that isn't consistent with the media coverage around what's actually going on with the spread of the virus. But like I say, reasonably positive that everything is slowly rebooting and reopening. And that's where the enthusiasm from a market perspective has actually been coming from.
Thanks, Yogi. Yeah, it seems to be a massive case of not fighting the Fed, but on a sort of global basis, where all the central banks, as you said, have printed almost $10 trillion. And one thing that sort of struck me is I think there may be a case of companies using 2020 as the sort of kitchen sink year, where they have been let off the hook to a certain extent because we were in a late cycle bull market, and companies were trying really hard to always try and beat their earnings and revenue estimates. And it seems to me that they can now use 2020 as the sort of excuse, if you want, to say, okay, well, that wasn't our fault. They reset the whole thing again. And the irony, in my opinion, is you now get into 2021 with much easier comparisons. And I think some of the positive psychology is coming from that sort of thinking, where we seem to have reverted back to buying dips and the psychology that we had up until January.
Yeah, Dorian, I think you make a really good point. If I were the CEO of a major blue chip S&P 500 company or a FTSE 100 company, I would use this opportunity to just really report negative news, because the market won't punish me for it, as we're clearly seeing. So I would try and bank as much as I could. If I could get away with cutting dividends, I would cut dividends. I'll drop share buybacks for the time being. And any bad news out there, I would just let it go into the marketplace, because the market is just ignoring the numbers. Everybody knows Q2 is going to be ugly. Everybody's expecting it. So you might as well put all your cards on the table. And I think that a lot of CEOs are looking at this and they're just saying Q2 will be the trough. We don't need to worry even about giving guidance right now. We can get away with not giving guidance. And then let's make a decision once we see the US reboot, once we see Europe reboot, once we see the UK reboot. Let's watch to see what's going on in China, because that's really a domestic story. And we can make a decision at the end of Q2. And that's kind of what we're seeing happening now.
Yeah, and so the other thing which I found fascinating yesterday was, and I'm talking about the S&P, but I think it was similar in other markets. So the energy, travel, retail, and financial companies yesterday were up anything from 5 to 20%. And what's fascinating about that is that a lot of the market recovery from the 2200 lows in March was led by the big technology companies, the Amazons, the Apples, and so on and so forth. And now they've seemed to have sort of stabilized, and at least they did yesterday. And now there seems to be a very big catch-up trade with a lot of the beaten down cyclicals that I've just alluded to. So this rally, from that perspective, in my opinion, does make sense, because the overall sort of S&P number was held up thanks to the large cap names, which obviously have a bigger weighting in the index. And now it's the really beaten down stocks that are starting to rally, but are still substantially low above their highs from earlier in the year. So maybe that's the case for this sort of rally continuing.
Yeah, you know what? The market rally that we've seen has been dominated by a handful of secular winners, as you quite rightly said, and they're all the growth names in the NASDAQ that we've seen. And look, NASDAQ is actually in positive territory year to date. It's up 4%, which is staggering, bearing in mind the journey we've actually been on. So whilst we've had a handful of growth-orientated secular winners, they're now taking a breather. You've seen them come off a touch. And now, as you quite rightly say, a lot of the cyclicals, a lot of the value-orientated names, a lot of the sectors that have beaten up are now playing catch-up. And that's actually quite a positive sign. And look, I think it's fair to say we're marginally overweight the US at the moment, obviously supported by monetary easing and fiscal stimulus. But we have had some resilient earnings in that growth-orientated sector. And thematically, everybody's been focused on cloud computing. Everybody's been looking at perhaps e-commerce, because those are both sectors that are doing really, really well in this space. We've actually just taken a view where we've started to reduce our NASDAQ exposure because we actually think valuations are too stretched and it's kind of run ahead of itself. And we're starting to build exposure in some of those beaten up sectors that you've already highlighted. We're a bit reluctant to go into hospitality or the airlines, and maybe even the financials, because of what's actually been going on with bank lending and what's likely to happen to the real estate market. However, the oil majors, we're quite comfortable with, and we've slowly been building exposure in the oil majors in that regard. And then anything with exposure to China, we've actually been quite comfortable with as well. But you're starting to see a rotation away from growth into some of these sectors that have been really beaten up, and that's helped support the rally going forward. Now, here's the caveat. Forward PEs in the US are now at 24. That's staggering, really, by historic standards. And even when you go into Europe and the UK, forward PEs are at 18. China's still hovering around 11 to 12. But those valuations are really quite stretched. There's some support provided by post Q2. There's some support provided by fiscal stimulus and monetary stimulus. There's some support provided perhaps by a weakening US dollar going forward. And that's where a lot of investors are getting comfort. But of course, the main driver of markets short term right now is the reboot of economies and a slowdown in infection rates. That's what everybody's really focused on, and that's where some of the optimism has come from.
And Yogi, you mentioned you feel comfortable in some of the oil majors. Can you give us a couple of names?
Yeah, we've been actually going out and buying a lot of the oil majors in Europe. We've been comfortable with their exposure. They've got really strong balance sheets, lots of cash, and they can weather the storm. Obviously, oil has since stabilized from its lows. It's now hovering around $33 to $34. So we're quite comfortable with that exposure. So we've done things like BP, we've done things like Total. We steered clear of some of the US oil majors because we're a little bit uncomfortable with some of the technicalities around WTI and distribution and what recently happened with oil going into negative pricing. But in Europe, things are looking a bit more stable with the oil majors. There'll be a resumption of dividend yields somewhere along the line as well. And those sorts of dividend yields up anywhere from 5 to 10% now are very attractive, bearing in mind where valuations are. So again, real comfort, only with the large cap oil majors, not the small mid-cap majors, companies that are perhaps more supply chain further down or focused on other areas of research or drilling. They're really struggling. We're not comfortable with that exposure at the moment.
And you touched on financials earlier. I mean, there's some very big names that are offering great value, but at the same time, we've got a yield curve which is not exactly conducive for financials, to be making money as net interest margins compress. Are there any names, whether in the US or elsewhere, that you would feel comfortable with?
We think it's too soon to build financials exposure. However, if you did want to take the risk, there are some great large cap names like Bank of America, JP Morgan, Goldman Sachs that we're comfortable with. We're less comfortable with the financials in the UK or Europe for a whole range of obvious reasons. The problem we've got with a lot of the financials is that they have a lot of lending out in the marketplace. Bad debt is the other phrase that's being used. They've been hit hard because of the credit issues that have originated. And we just think it's too soon to build exposure. They're not lending. Interest rates are very, very low. They can't really make money. They're really going to struggle with the real estate market as they slowly find out that there are a lot of people that can't pay their rent. There are a lot of people that can't make their mortgage repayments. So we just think there's more pain to come. They're probably about 8 weeks behind everybody else in terms of adjusting to what's happened with the lockdowns and COVID and its implications. Just a little bit soon. There is obviously an ETF you can pick up if you want more broader-based financial exposure, XLF. Dorian, you've probably got more exposure in this regard. US domestic focused. Again, there are some great high quality names there on a market cap weighted basis. It's for the brave. I wouldn't be jumping in right now. Just hold on for another 8 weeks just to see what happens.
Yogi, I had a very interesting call this morning with a friend of mine in South Korea called Kwan Yoon. And South Korea, of the Western countries around the world, has actually reacted the quickest to, and in the most technologically efficient way, to COVID-19. And that's leading the West out of these issues. And I had a chat to him. I said, how are businesses doing on the ground? He said, there's kind of a disconnect because Korea is an export nation. All the main chaebol manufacturing industrial businesses, are up and running again, but they're hitting supply chain problems and export-related problems in other countries. And those problems are severe. But anything that is online or tech-related is going through the roof, unimpeded. And he said, there's the dichotomy. And the other dichotomy was the cover of The Economist that was like Wall Street, Main Street, complete dichotomy. When quantitative easing is pulled back or stopped, and people realize that, is that the time for the other down the plug? There's all bad news.
The whole issue around quantitative easing and whether it will continue and what is likely to happen is one you've got to pay a lot of attention to. I go back to what drives share price appreciation. And what drives share price appreciation is earnings numbers. Remember, price to earnings ratios. So what we really need to see is a pickup in earnings. Now, earnings are a consequence of revenues minus costs. That's the formula. So really, we all know that earnings numbers can actually be manipulated because the cost number can actually be changed. So what we're tending to focus on is revenues. If we see strong revenue numbers or strong guidance relating to revenues, then we believe things will be okay. And that's what we've been focused on. I think what's happened in all of Asia is really quite telling. You've had revenues crash because everything has been locked down, and revenues are slowly starting to reboot, and it's just really too soon to be able to tell. But the markets believe that revenue number will slowly kick up and improve despite what's going on with supply chain issues. And I think a lot of it comes from what's actually going on in China. And we've been really comfortable with China and Chinese exposure. Obviously, there's a lot of tension between the US and China at the moment. That seems to have escalated over the last week to 2 weeks. There are further sanctions expected, but the market's really ignored it. They've actually looked to see what China is doing when it reboots. They've looked at the domestic story. They've seen a central government, a central bank, really quick to respond in terms of fiscal stimulus, monetary stimulus. I even read last week they tested 7 million people for COVID over a 12-day period. That has given a lot of investors confidence that they are able to do things very, very quickly and very responsively. There's obviously some news flow around China imposing Hong Kong national security laws, which is causing more unrest. But again, the market's ignoring that. The other thing that I think is really relevant in terms of what's going on in Asia that I think is being missed at the moment is what's actually happening to the yuan or the renminbi. We've seen some significant weakness filter through at the moment. The fix today or this week is 7.13. That's the weakest level we've seen since 2008. So we're expecting to see currency weakness helping to support the marketplace. We see domestic demand actually improving. We see a reboot of the economies. We see 7 million people tested over 12 days. We've seen masses of fiscal stimulus, a monetary response as well. We've seen a government that's really quick to move, and that gives us confidence. That spreads out into all of Asia. The environment starts to improve. You can start to see why people are getting more positive. China is doing about the same as the S&P 500, slightly better in terms of equity market performance. You've got much lower price to earnings valuation metrics as well. Maybe it's not all doom and gloom, and maybe things are slowly starting to improve there. The worry, of course, is that we get a second wave and then all the consequences that go with it. But they've proven that they are quick to react. They have seen things actually slow down and almost stop. They've reopened. Travel has picked up. You start to look at China as a sector, and we're saying this is a space where we would like to get some exposure, and we've been slowly building our exposure as a result.
Yogi, one more question from me, and then I think we're going to open it up to some of the members who are furious writing questions for you. So it's obviously an election year, and historically, the incumbent president has an advantage if the year of the election, the economy is doing well. So it's kind of a weird one this year because the economy was doing very well up until Q1, and now it's sort of fallen back into a black hole. But by the time we come to the elections, by definition, even though we may only get a small rebound, sequentially it's going to look in percentage terms very positive. So how do you think that plays into the election?
Yeah, I think the election is the big risk at the moment that the market hasn't paid a lot of attention to. And I would urge all investors to look at it quite carefully. We're starting to look at the numbers. And it looks like a very close call. I wouldn't be surprised to see Biden actually win, so it's a Democratic victory. Trump has been very positive for the US markets and so the global markets because of all the fiscal spending plans, because of all the tax cuts, because of the deregulation. If the Democrats get in, that's not going to be so good for the US markets. You'd expect to see taxes increase. You'd expect to see markets probably likely correct or sell off. But there will be clear signs in the run-up to the election that this is going to happen or this is a likely outcome. All the commentary I'm hearing from the US now seems to have removed or moved away from COVID-related talk and lockdown-related talk to what's actually happening with the US elections. And are we going to get a change? On balance, I wouldn't be surprised if we saw a Democratic win. What's really interesting is the tension between China and all the rhetoric and all the issues that obviously did exist and then quietened down and have now reappeared, coincide with Biden taking and winning votes across the board, particularly in some of these borderline states. Isn't that a surprise? You know, the cynic in me says Trump's just making noise, creating noise, making a China an issue, when it probably doesn't need to be an issue because of what's actually going on domestically around the election front. So I think it's one of those risks that you probably have to pay a lot of attention to. And I said right at the beginning, you know, three big questions. Can the equity rally continue? Yes, it can, is the answer. But we're expecting to see a pullback probably around the end of Q2. And whether there's a second wave of infections, that's obviously going to cause some concerns. But this time, at the end of the year, we expect markets to be higher. Perhaps next year, we expect markets to be higher. The other question I mentioned is the vaccine treatment optimism justified? We don't believe it's justified, and I think investors have to be really careful here. I think a lot of the data that's coming out is premature. It's not been tested. It's not been accepted by the scientific community. Remember when HIV came along? It took us about 30 years to nail it. What makes you think we're going to nail this particular issue in 3 months or 6 months? And the other thing to bear in mind here about vaccines and treatments and the spread of the virus, you know, this last year, influenza killed 670,000 people globally. That number's massively understated because when somebody dies, you don't actually screen them to see if they died of influenza. Right now, with COVID, anybody that dies, they're screened for COVID. And if they've got it, it's recorded as a COVID death. So we think the COVID deaths are overstated. The influenza deaths are understated. You look at tuberculosis, the figure's 1.2 million people that die every year. And again, probably understated. All these conditions are massively contagious. You know, we've got 2 vaccines predominantly for influenza with 199 different strains actually out there. So the point I'm trying to make here is that the lockdown that took place was very necessary. It clearly saved lives. But right now, you've got to ask yourself the question, can we continue living in a bubble? And the answer is no. People have to get back to normal, and there is a consequence that we have to live with. But we've been living with this consequence with influenza for decades, and it hasn't changed the way we do things and what we actually do. And influenza is very contagious, and it's a big killer as well. So I would say to investors, don't over-focus on what's going on with COVID. It's clearly not good. It's clearly really bad. We've had masses of stimulus out there. The vaccine's a long way off. Think beyond what's happening this year. Try and think about what's going on next year and start to allocate to risk accordingly in a slow, cautious, careful manner. Now, the third question I mentioned was the whole election thing. And I think we've kind of discussed that. There's a reasonable chance that the Democrats will win. Not so great for markets, but we'll see it coming. It will be like a juggernaut with its full beams on, flashing away at us, and we'll be able to adjust from an asset allocation perspective and from a risk perspective going forward. We haven't mentioned bond markets. We haven't mentioned currency markets. They're both very, very important in respect to what's actually going on as well, because bonds are very expensive. The dollar is very expensive on a PP basis. That helps investors get more comfortable with allocating to risk, particularly if names are beaten up in the equity markets.
Yogi, there's some questions on the right here from the audience. You can see the name of who's connected to them. Some are highly intelligent, like actually not very many are. Matt Curran asks, what sector market is your top tip for investing in today?
So when you talk about sectors, thematic sectors, I don't think you're going to go far wrong with anything to do with cloud, and I don't think you're going to go far wrong with anything to do with home entertainment, be it gaming, be it the likes of Netflix and so on. We love e-commerce, particularly in Asia as well. If you're looking at geographical allocation, we are still overweight the US. Remember, the US is a $19 trillion economy. The next biggest is China, around 12 trillion. And then you've basically got Japan at 5 trillion, Germany at 4 trillion, and then the rest of Europe at 3s and 2s. It's about the US consumer. And if the US consumer starts spending, and we think they're more likely to start spending than the Europeans, for example, then things will start to improve. So we're overweight the US, we're underweight Europe. We were becoming a bit more constructive, the UK, but less so now. And we've already gone over the argument for investing in China.
What about gold? Give us gold. Who asked us the gold question?
Yeah, gold is a really, really good question. I think you have to be really careful with gold. I think gold will be a short-term provider of liquidity when things go wrong, but things clearly aren't going wrong at the moment. Things are slowly improving. The other thing I would say to you about gold, and a lot of your guests here will have a good understanding of gold. Gold in the 1990s was roughly $400 a troy ounce. It hit a low point in 2001 of $251 a troy ounce. It went all the way up to $1,900 a troy ounce. And we all know now where it's trading. This isn't a safe haven asset class. This is incredibly volatile over certain periods. There is a lot of fast money participating in it, a lot of levered hedge funds. It's a very small market. There are lots of ways that you can access it through ETFs or physical gold, but there's only enough gold in the whole world to fill an Olympic-sized swimming pool. So everybody thinks it's a great safe haven. They should hold it. I would urge you to be very, very careful. We think that there are more short sellers out there in the marketplace. We think it's more likely to sell off than stay stable or increase. And if you're looking for a safe haven trade, just buy the US dollar. Just go out and buy the 10-year. I know there's masses of issuance and yields will pick up, but I think you're likely to do better than you would holding gold.
But Yogi, this question comes up all the time from our crowd. Crypto. Yes, no, don't know. That's
it's a really good question on crypto. I've been really intrigued by the price action at the moment. Again, I think there are a lot of regulatory issues around holding crypto. I think there are a lot of issues around actually getting exposure and accessing it. I think there are also a lot of big players that can move the market in quite a meaningful way. My worry is that it's a safe haven for those that are predominantly in emerging markets who don't have a lot of confidence in their domestic currency. I would argue that the true value of cryptocurrency is zero, but I think that's quite naive, and it clearly has a role and will develop over years to come. I think it's too soon to start participating in it because of a lot of fast money or emerging market money participating. And there's a lot of regulatory issues and exchange-related issues around getting exposure. We would steer clear of it. If you're looking for a safe haven trade, US dollar, even real estate over the longer term, but in prime areas, it's hard to see how cryptocurrencies are really going to protect your wealth over the longer term. If you're looking to trade, and you're a speculator and you're a trader, be my guest.
Yogi, before Dorian dives in with a top, highly intelligent, well-crafted question, unlike mine, just a quick one. Hywell George, who's in Franschhoek, asks, are you a bull on a 6-month view or a 3-year view?
I'm definitely a bull on a 3-year view, without a doubt. And I think there'll be lots of volatility over the next 6 months. I think the way to look at the next 6 months is use it as an opportunity to build exposure. So, for instance, we have reduced our NASDAQ exposure because of valuations, and we've been allocating to more defensive, value-orientated names such as the oil majors. We've also made adjustments to our bond exposure. The 10-year looks ridiculously expensive. We know that there are masses of bond issuances coming to the market. The US have announced $3 trillion of government bond issuance, which is a staggering amount when you look at the numbers. So bond yields will actually have to go up. We've been reducing duration in anticipation of bond yields going up. So we've been telling the 10-year, buying the 2 to 5 year with a view to reallocating over the next 6 to 12 months as yields pick up. So there's some really smart trades to do over the next 6 months. It's a really good question. They're not bullish trades. They're trades around reallocating to risk, bearing in mind how we think things will be 2 to 3 years down the road. Good question.
And just sticking to that theme, Yogi, so now in the UK, they're talking about potentially some negative yields. I mean, at some point, this has to come to an end, right? Because they're issuing, I mean, globally, we're issuing a huge amount of government debt. And we went into the credit crisis 11 years ago on the basis of leverage and too much debt and a little bit of hanky-panky with the credit agencies who weren't quite sort of doing their work. And we've solved credit issue, debt issue, by giving the drug addict even more drugs. And at what point do we solve this differently, and how do we do it? Because this is the one thing that worries me the most. And I don't know if this event is in 5 days, 5 years, or not even in my lifetime, but at some point, we're going to have to do something to stop the cycle.
I think your question is a really good question, and the issue is one that we think about all the time. We saw negative rates in the UK for the first time ever from my experience, and I've been doing this now for 20 to 25 years. It does worry me when you look at the amount of bond issuance that is likely to come to market and its implications over the longer term. As an investor in bond markets and equity markets, you end up having to make a decision because you can't sit there on cash. Your cash isn't really protected. If a bank has problems, their debt is obligated before the cash on deposit. You have to have exposure to bond markets. Just where do you have exposure in terms of yield and duration, and where do you have exposure from a credit perspective? I would make an argument that you don't take risk in the bond markets, not meaningful risk. Don't go chasing yield in the bond markets. I see this all the time. If you want to take risk, adjust your asset allocation and allocate to equities. Valuations will be more reasonable. You get a dividend yield, and that's how you titrate and increase risk. The big risk in the bond market, and is the point that you've made, all this issuance will come out. And who are the natural buyers? who's actually going to go out and buy all these bonds. At the moment, people are buying because they're long cash and they're not quite sure what to do, and they're not willing to allocate to equities. So they are slowly going to buy, but somewhere along the line, this definitely has to stop. Somewhere along the line, you will see rotation back out of equities, back into the bond markets. But at the moment, the flow is likely to go the other way. I think you just have to watch it really, really carefully. I believe bond yields for the 10-year US Treasury will get up to 1% quite quickly. I then think they will go up even further, and you'll start to see a normalized yield curve that we can start to pay attention to. I think credit markets have already started to correct. Dorian, you've already seen that. Not just with support, but you've seen the spreads tighten in quite a meaningful way just over the last few weeks. There's no free meal ticket in the bond markets. There's no inefficiencies. We don't want to touch high yield bond. We don't want to take excessive credit risk because we know default rates are likely to increase and are on the up going forward. The other point I would make about the bond markets and this bond trade, and it often makes me smile. Everybody goes out and buys the US 10-year. It's an insurance policy. And then the world blows up and they hold on to their insurance policy. They don't actually sell it. When the world blows up, the idea is that you sell the 10-year and then you buy the 2-year or the 5-year. And that's how you capitalize on your insurance policy. You don't wait for the 10-year to then come back. And then it was a pointless trade and you didn't actually exercise your insurance policy. And we need to see a lot more of that actually happening as well. It's not about being an insurance company meeting cash flow obligations going forward with a laddered approach of 1 year all the way through to 20 or 30 years. This is about private client investors who are traditionally the biggest investors in the bond market, actually using the 10-year as an insurance policy in the way that they're supposed to from an asset allocation and investment perspective. And that's what we would urge all your listeners to do in the way that they look at investing in bonds. Expect more blood shed to come over the coming months and years in the fixed income space, definitely.
That sounds reassuring.
Dorian, why don't you 2 more questions and we'll wrap?
Yeah, so let's see. A question from Matt Kreitzman. Yogi, what is your view on the Chinese stocks in the US now with the HFC Act?
Yeah, I think they're a great buy, and we've actually been buying the Chinese stocks listed in the US. We know that there is tension between Trump and the Chinese, but we believe this to be rhetoric and more to do with US election risk. We're very comfortable with Chinese domestic exposure. We're very comfortable with any listed Chinese names in the US exchanges. So thumbs up. And we're very comfortable with exposure in that regard.
And then one last question from me. How much cash do you have in your portfolio?
Everybody's different, and everybody looks at it in a very different way. We manage cash mandates. So we've got some portfolios that are 100% cash management. But if you're talking about balanced portfolios, so let's just use the word balanced very generally, 50% equities, 50% bonds, we've actually brought our cash levels right down to below 5%. We have been as high as 10 to 15%. The excuse was dry gunpowder to allocate to risk. But what we have been doing over the last month is slowly allocating to risk. So we've taken that cash level right down. We're not as worried about markets as the media are. We're not as worried about COVID from a market perspective, I hasten to add, in the way that the media is. And I think that's played out in what's happened since the end of February, the beginning of March, in the way markets have improved, that V-shaped recovery taking place, markets correcting in a very positive way. We've also taken a lot of comfort from stability in the VIX, the volatility measure that everybody actually looks at. And we're now looking at things, and we know that there is pain to come around Q2 earnings season. We know that there is likely to be a second wave, but we suspect that will come towards the end of the year when temperatures drop. There is a risk about emerging markets and spread of the virus in countries such as Brazil and also Russia. So you've got 3 or 4 things, along with the US election risk, that could lead to additional volatility. So we haven't wiped out all our cash. We've been gradual in building exposure. We've adjusted risk within our equity exposure, such as selling NASDAQ and allocating to value and defensive names. But the idea now is to just build exposure going forward, not go down to zero, not just sit on the sidelines and wait for things to improve. You've got to be active in this environment. Passive doesn't work. You can't wear that Warren Buffett cap that I hear all the big banks talk about. Oh, we're long-term investors. We're just going to ride it and watch to see what happens. I believe that's nonsense. And I think you've got to be active and be thoughtful and make adjustments accordingly.
So Yogi, just before we wrap up, other than your evening job as a mud wrestler, what do you do during the day? Can you tell everyone?
Yeah, no, absolutely. I am a father to 4 children. They are teenagers, aged 20, 19, 17, and 16.
Yep.
I love them dearly, but they are teenagers. Any of you that have teenagers will understand that statement. They've been incredibly consuming in the way that they need attention and support during this lockdown. I've taken to not continuing to work and your personal life kind of blur into one during this lockdown. But all of us in the office are locked down, working really, really effectively. I've actually taken to doing some gardening. I feel ashamed of admitting it. And last week I went out and bought a juicer for the first time ever. And bizarrely,
Yogi, I think this is going too far. You were doing really well until then, until the juicer. Yogi, thank you very much. Dorian, thank you. What a great afternoon, and keep it up. Glad to have a bull on here. See you soon. Thank you, Yogi.
Thank you, guys. Cheers.